It's time for Michigan's retirement coach, Mike Douglas.
Does your investing philosophy have to change in retirement? Let's discuss. This is certified financial planner, Michigan's retirement coach, Mike Douglas. I'm Heather Branch, here to ask Mike questions about the shift, the perspective shift, the investment shift. There's so many shifts shifting everywhere. It's like driving a manual when we head into retirement.
So many people won't get that reference. It's so awesome.
I think at this phase of
we'll get it.
No,
the older generations will get it.
Yeah, but I think that my niece is turning 16 and she talks about wanting to learn how to drive a manual. So some of the stuff, I know. You know how the kids are these days where they're wanting their VCRs. They're like, look at this cool thing.
They're nostalgic. Yeah.
So maybe we'll come back.
Kids don't know what it means when you go like this.
Roll down the window.
Yeah, it means roll down the window. They have no idea.
Well, for folks watching this YouTube, listening to this podcast who do understand what we're talking about, you are at a certain phase of life then likely. And you have gotten to a point where you have been working, saving, for many of us, investing in effort to grow that nest egg. So you've invested for 30 or 40 years. You're considered a long-term investor. But as the world changes and we as humans evolve, Mike, a lot of us will be living as long in retirement as we spent working and saving. So why would we not be considered a long-term investor then in this phase, in this next phase, in retirement? Do we need to have an investing philosophy shift of our own in retirement?
Yeah, I think so. I think that we want to not completely shift away. Like we don't want to be completely short-sighted and just only think about
because we're
the next 2
in
years.
Retirement for so long, we can't just completely get away from market investments, right?
Right. And we have to have the understanding that the money has to last as long as I do.
Right.
But yet, now that I'm living on the money, because when you're a long-term investor but not a spender or a user, right? We're not withdrawing from the accounts. Everything is someday money. So I just keep dollar cost averaging. I keep investing in, and I invest with a very long-term strategy. Well, then I retire, and all of a sudden I need the money now. So people start to act like I need to make the whole portfolio look like I'm going to use it now. But you're not. If you have $1 million in your 401k, which isn't even like a crazy number anymore, you have $1 million in there, you're not going to use $1 million this year or next year or even in the next 5 years. So what you need to do is start laddering out your money in terms of a timeline. You need to say, all right, how much am I going to use in the next 5 years? And de-risk that portion to a certain extent.
Okay.
Right? Don't let it be overly aggressive. Why? Well, because if you're going on a cruise, you're remodeling your kitchen, or you just want to live off the money, you don't want to have the market correct and you can't do those things. So you take the next 5 years worth of money and you put it into, whether you call it a bucket system or a laddered system or whatever you want to call it. But the next 5 years worth of income needs to be at a lower risk, therefore a lower yield. But that's okay.
Okay.
If I need $50,000 a year, I take $250,000, put it into something that's going to get me, I don't know, 3 to 5%, maybe 6%, but just a less aggressive thing, and let that thing give me the income I want. Then the money that I don't need beyond that, I separate into 6 to 10 year buckets or 10 year plus. And if you give money a 10-year window, studies have shown that unless it's 2000 to 2009, the lost decade, other than that, almost always out of a 10-year stretch, you should get 7 or 8 positive years out of that 7 or 10-year stretch. So from there, that should make the money grow quite a bit. So as a result, we take the next 6 to 10 years, that chunk of money. So again, if we're taking that $1 million number, let's say you take 250 and you put it in the lower risk year 1 to 5.
Okay.
Now I take another 250 and I put it in the years 6 through 10. That money, I want it to go get me, I don't know, 6 to 8 or 9%, like a moderate portfolio. That way it has inflated up every year enough to cover my $50,000 a year plus inflation. Then the money 10 years plus, I want that to be in the market. I want it to be go chasing returns, because I have time to recover. I have time to do what it needs to do. And so you can build a portfolio that says, when I need the money, it is de-risked. And every 5 years, you de-risk another portion, and keep bringing it back.
Okay.
So I think that's an important way to look at it. And if you do it that way, your money can last you a long time, as long as you're working without being overly risky.
Okay. in a perfect world, this all sounds great. However, we live, and by the way, Michigan's retirementcoach.com is where you can go to start the conversation. If you have questions for Mike and his team, we also have links posted in the show notes. As I was saying, I mean, this all sounds great on paper and in a black and white world, but we live in a world where suddenly we're back in the Middle East dealing with a crisis there. And inflation is, just in the past couple of weeks, we've seen inflation and interest rates. Because Kyle and I I was looking at refinancing our mortgage because we were going to lose a 1% rate off our mortgage on a Friday, and then the weekend happened where where the crisis in Iran began, and then by Monday, it was over. We could no longer get that interest rate. So everything's in flux right now. Gas prices are up, and I think that it's a reminder again of the timeline for those of us going into retirement. We're going to be doing it for 20, 30, for some people 40 years. So again, the market, does it play a different factor? Is it going to continue to play different factors for generations moving forward?
I think the way it invests will change moving forward, but you're exactly right. So we want to take a long-term view to make short-term decisions.
Okay.
So is it right to refinance your mortgage for a lower rate? Absolutely.
If it makes sense, if it is worth it, because that's the thing also, you got to bring money to closing. It's like $5,000 to $10,000 depending. So yeah.
Right. So you make sure it's worth it.
Yeah.
But if you do it, that's great. You may have to pause. I know the big term, I saw one of those great collages, like where they take all the newscasters saying the same thing on like a million different channels. And they're like, who's feeding them
loop
this
it over each other,
right?
Yeah.
Yeah. And so this one it's short-term pain for long-term gain.
Okay.
That is the phrase we're hearing. And it's interesting. Normally what happens is you hear it like all the right side has their talking points or all the left side has their talking points.
Yeah.
And like, it's different. This one's been very interesting across the board. I mean, you go from MSNBC, CNN, Fox News, Newsmax, all of them. They're all saying the same thing. It's a short-term pain for a long-term gain, meaning that what's going on in Iran, it will cause some flux in gas prices. We just saw this this past week, the largest oil swing in history on Monday when it spiked up and then it shot back down, the largest swing in history in a 24-hour cycle. Yeah. But it's almost like the COVID, but it's of oil, right? Like there's all this uncertainty, all this chaos.
Dare you? Watch your mouth when you're talking to me.
Right. And it's like when all the chaos happened and the market tanked because of COVID.
Yeah.
And then just as quickly as it disappeared, within 2 months, it came back. 3 months, it came back.
Well,
in the same way, we're going to see these oil prices right now, the Straits of Hormuz, as long as that thing is, I think I heard today that 20% of all the world's oil comes through that strait.
Right.
So right now, if the tankers can't get through, then they can't get rid of the oil. So they stop producing oil because they can't offload the boats. Like it's a pretty basic thing.
Yeah.
But as soon as that gets dealt with, we're back to normal. And we should be able to see the tankers go through, the oil come back down, all that. So it's a temporary hiccup. It's a symptom of the Iranian crisis sickness. It's not a symptom of a bigger sickness that there's not enough oil in the world or whatever. So as a result, we will see that come back. But again, this is a perfect example of when you're retired, do you want headlines to dictate your lifestyle?
Right.
Do you want headlines to dictate whether you get to go on that trip? Now, maybe this is not the time for a Middle East cruise.
Maybe you're going to buy some traveler's insurance.
Maybe that can affect it, right? But I don't think that this should deter you from going on an Alaskan cruise.
Okay.
You know what I mean?
Okay.
We want to build a lifestyle where, whether it's through using secured income through an annuity or a dividend portfolio, or we just use a withdrawal strategy off the stock market, whatever you want to do, we want to do it in a way where, hey, I know there's going to be some market volatility. I know there's going to be some chaos. That's why the money I need next spring isn't going to be subject to market volatility. I'm not going to be in energy. I'm not going to be in fast moving tech with money I need next year. I'm going to be in very conservative positions that will not, even if the market tanks, it may drop 1 or 2%, but I still go on the cruise. I still remodel the kitchen. then the money that's a little further out has a little bit more leash, a little more aggression, a little more opportunity. So the farther and farther away I need it, the longer leash I give it, which means when it falls, it's going to fall faster, but when it rises, it will rise faster. So that's the nature of retirement investing. You are still a long-term investor, just not with the whole pot of money. Unless you say, hey, I'm kicking off this earth in 6 years and you've got a crystal ball for that.
Mm-hmm.
Other than that, we still have to invest with a long-term horizon,
Yeah.
but don't risk your short-term money.
Okay.
And I think that's the thing that gets missed. People think, oh, I'm retired now, got to go conservative. People are living longer and longer,
Yeah.
and we need money to last all the way to age 100.
Yep.
You know, it's not that uncommon.
Yep.
So especially with what AI is going to do, that's a whole separate podcast. If you let me go off on what AI is going to do to medical research
Okay.
and longevity and lifespans.
Yeah.
But I think it's very reasonable to say that getting to age 100 is not wild or outlandish, and it will become much more common in the next 20 years.
Yes, agreed.
So 70-year-olds right now are going to have a wildly more likely chance to get to 100 than people 10 years ago.
Yep.
So what we need to do is make sure the money lasts as long as you do. You can't dig a hole in the backyard. Well, I can't say you can't. You probably shouldn't dig a hole in the backyard and just only pull out what you need.
Yeah.
You want it to grow. You want it to beat inflation, and you want it to participate in the good times in the market. You have to, as my father-in-law always says, you have to make hay when the sun shines. So when the market's good, participate appropriately. When the market's bad, you have to participate appropriately, and just build a portfolio that's meant for you.
Participate appropriately. That's I think the key takeaway when it comes to our market investments. Getting into retirement, yes, you probably need to change your approach to market investments, but you don't want to get out of the market entirely. You've got to plan for perhaps 30 or 40 years in retirement. So appropriate allocation of your assets, figuring out how they all place out in a plan that's customized to you, because it is also different for everybody. So if you've got questions about how to adjust your investing philosophy going into retirement, Mike is here to walk through that with you. You can reach out to us. Visit us at michigansretirementcoach.com or just click on the links we've got posted in the show notes.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit michigansretirementcoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.